Okay, so recording is started. So we're talking about old age security. So
Okay.
with old age security, we said depends on how long you lived in Canada. Less than 10 years, you won't get anything. Over 40 years you lived here, you'll get the maximum, which is $613 these days. If you lived in between those years, then it's prorated. So if you live 20 years, you'll get half of it. And if you lived in Canada for over 20 years, and then you, in retirement, go live abroad, you can still continue to get the payments abroad. But if you lived here 10, 12 years, 15 years, and then you go live abroad, then you don't get it, then it stops after 6 months.
Okay.
So that's the other thing. Like, some people, the example there is, some people, when they're retired, they go to Florida, they go to US, right? It's warmer there, right? In the winters, or they go permanently there to a warm place. So if they have lived here over 20 years, they can continue to get it, but it's just going to be like maybe $500-600 a month, but still it'll make a difference.
Right. Okay.
So the benefits are that at age 65 only. So the key thing to remember is you cannot apply for it before. You have to apply for it at age 65. And these days it is around $613 a month. You can delay applying if you apply age 66, 67, 68, you can delay that. If you delay applying for it, your monthly payment is increased by 0.6% per month of delay. So example, Alice delayed her old age security payment for 14 months. So she will get 14 times 0.6. It means, because it's 14 months she delayed, so times 0.6 means she will get 8.4% extra payment.
Okay.
So we have to calculate what is 8.4% of 613, and that will be giving you now $664. So she's going to get 664 instead of 613.
So delaying is a benefit, obviously. Yeah. Okay.
But person doesn't know about health or age or their death. If the person delays for I'll take it at 868. You never know. 867, poof, person's gone. Then so what? So
Yeah,
right?
that's true. Yeah, that's
Right. So that's the thing. You don't know about life either, right? So but anyway, so why don't you do a calculation? Okay, if she delayed her payment by let's suppose, I'm going to make up a number, let's suppose she delayed it by 24 months. Can you tell me, you have a calculator and paper pencil, can you calculate how much it will be for 24 months? How much extra payment will she get?
Yeah, just give me 1 second. Let me pull this up here. Okay, so there, where is this? Oh, is that, can you see me?
I can see you, yeah.
Okay, and the slide has gone away. I don't know what happened here.
Oh, maybe you open up the calculator. Then did you open up the calculator on your computer?
Yeah, I took away the. It says what is it saying? Should I reopen the Zoom meeting again? Because it's I can hear you but I can't see you.
Okay, let me hold on. Let me see. Do you see me? Let me stop my video. Do you see it now?
Okay, yeah, now it's perfect. Yeah.
Okay, now let me share screen again. Okay, here is this. Now you can see the screen?
Now I can see, yeah.
Okay, so yes, so what did you calculate? How much did you calculate extra she's gonna get?
Okay, so I'm just doing that right now. So it's gonna be she. Okay, so this is okay. So how much was it? Sorry, how many months you said? 24?
Yeah, I think let's make it easier. Let me stop the video also. Your video also, is that easier now? That makes it easier to see, right?
Yeah, now I see it. Okay.
Yeah, because the videos come in the way. Okay, so see here, it's 0.6% per month of delay. Let's assume she delays for 24 months. So you want to do 24 times 0.6.
Gotcha. Yeah, okay, yeah. So 24 times 0.6 equals 14.4.
So 14.4% increase. So can you tell me how much it will be increased by if it's $613? How much it'll be payment now with a 14.4% increase?
$88.
Yes, perfect. $88.27. Yes,
27 cents.
Yeah. So that'll be, of course, added to this, right?
So 613 plus 88 would be the new figure. Yeah.
Gotcha. Yes, it'll be $701. Yeah.
Okay.
So she's going to get $701 for as long as she lives every month, right? So that's a, increase. It's better for her to delay, but if, of course, depending on how long she lives and all, right?
Gotcha. Okay, perfect. Yeah, that's
Clear? So that's the thing there. And again, the contribution, there's no contributions for old age security. It's funded by tax. So, but I mean, you can't say it's free. I mean, indirectly, we're paying for it right now. We're paying income taxes, right? All the people are paying income taxes. A portion of it goes into old age security, right?
right.
And
Exactly.
then when we retire, then whoever is working, they're paying income taxes. Those are coming to pay for us. So, I mean, it's indirectly we're paying for it, but not directly.
Right.
And then there's a taxation and clawback. So, yes, so taxation. So yes, the 613 is not free money. It's going to be taxed. Just like, now the SERB is going to be taxed also, right?
Mm-hmm.
So same thing. So old age security will be taxed. Now we said there's two portions here. Let me also put that here. Yeah, so we said there's 4 portions of the old age security. One is the pension. Pension is the old age security, which we mentioned, age 65, you can get it, right?
Mm-hmm. Yep.
There's also the guaranteed income supplement, which is extra money. It's about, I think, as far as I remember, $700-800 a month, but you don't have to know the number, but it's for low income people. Okay, so that's extra. GIS is not taxed. So GIS, this is extra. And again, there's no contribution to GIS. So this is not taxed.
Okay.
Okay. And just remember it for that is just remember it's low income people. So they're not going to be taxed on it.
So low income would generally means
usually it's like under 30 or 35 or 40. There's a threshold as far as I remember, 35 to 40,000 annual, roughly below that limit, then you get the GIS.
Gotcha. Okay. Yeah.
So that's one thing, yes, low income. And then if somebody's income is very high in retirement, so if they retired and they're still getting rental income and they're getting pension income and they're getting other stuff, then there's a clawback. The government says, okay, hold on, this is like $6,000, $7,000. If your income is over $79,000, that now is like in 2020, that limit. If it's over that, then old age security is clawed back, meaning it has to be refunded. So in 1 year, you're going to get the old age security. Then next year, you do the taxes, and they're going to say, hold on, your income is higher, so you have to pay back your old age security then.
Okay.
Okay, that's called a clawback. Let's take an example here. Harry's income was $88,000. He had to repay how much? So we do 88,000 minus above, this is the limit, 79,054, right? So 88,000 minus 79,054, right? Let me make that a little bigger here. There we go. This is better. I know this is, sorry, covering up, but yeah, 88,000 minus $79,000. The difference is 8,946, right?
Mm-hmm.
And then 15% of that means 1,341. So he's going to have to pay back 1,341 of his old age security. So out of the $7,000 he got in the year, he has to pay back 1,341.
Okay, gotcha.
Okay, so that's how you will calculate the extra amount.
Okay.
And then the other one we said, the allowance is for low income people. If their age is 60 to 64, then, so this is, okay, if there's suppose husband is older, spouse is younger. Husband is 65 or 66, okay? And the spouse is 60 to 64 in that range. Usually there's about like 5 years difference, right? So now the person who's getting the old age security, the spouse, if the person is alive, the spouse can get what is called the allowance. So that's an extra amount. The spouse received old age security, and so the wife will get extra payment called the allowance, and that's only for these 4 years. Then the spouse is going to become 65, and then they're going to get their own old age security. Okay, so that's if the person is alive. If this old age spouse dies, then there's what is called allowance for the survivor. So the spouse gets extra payment, which is called allowance for survivor for those 4 years, and then he or she was going to get their own old age security.
Okay.
So this is just for only these 4 years.
Only for the 4 years, 60 to 64. Okay.
Yes.
Okay. And I have another question. So it's either, so you're old, so you have 2 options. It's either OAS or GIS, right? It's not, can be both.
No, it's both. Yes, the low income people, they will get GIS, and they will also get the pension, the normal. So they will get 613 plus the GIS.
On top of it, okay. If you're low income bracket, okay, got you.
Yes, if you're low income, yeah, that's extra. Like I don't remember, 800-900 maybe a month extra, so they will get more money. Yeah, they'll get both.
Okay.
Okay, and then this is for the old age security person. This is for the spouse. If this person spouse is younger than them, like 60, 64, they will get this allowance also, right? So technically, they could be getting all three in their household, right?
Okay. Yeah.
So that is possible. But if this person dies, then the spouse will get the allowance if she is or he is between this age.
That age. Okay, I get it.
Okay.
Yeah.
And
Yeah.
then when they become 60, 65, then they will get their own pension. And if they're low income, they will get GIS.
Understood. Okay, gotcha.
Got it?
Yep.
Good. All right, let's go on. So next we talk about Canada Pension Plan. So Canada Pension Plan is here, you have to contribute. So right now it's 4.95. I think in your book also they say 4.95% each, employer and employee.
Mm-hmm.
But last year they changed it, actually 2019, but you don't have to remember that, I guess, in your book. I don't know, you can check in your book, but I think in your book this is what it'll say, because they probably didn't update it yet.
That's what it says, yeah, 4.95, yeah.
Okay, that's fine, yeah, because it's 5.1% now, but that's just been enhanced recently. But anyways, this is, so you just remember it's around 5% each. Okay, so it's 10% of your salary is going to be going into Canada Pension Plan. So that is a savings, which is a plan where you are contributing as an employer. All employees, of course, contribute to it, and employers contribute to it. So it is contributed from salary or business income, and contributions if earnings are above 3,500 annually, up to YMPE. So what we're saying here is that annual income, 3,500 annually. If their income is above that, then they contribute to the CPP. If they're less than 3,500, they don't contribute to CPP.
For the year?
For the year. This is annual, yes.
Okay.
Okay. And then, so whenever you calculate, you have to minus the 3,500 from it. I don't think you don't have to worry about the calculation, but this is just, and there's a limit above, like these days, the limit is about $50,000. So if your income is above that limit, you don't contribute anymore. That's the maximum. There's a limit on how much you contribute to the CPP.
Okay.
Now, when the person becomes, so this is eligibility, yeah. And then, so when the person becomes, yeah, can apply age 59, actually 60 to 70. So here, remember old age security, you cannot apply earlier. You cannot apply before age 65. Here, you can apply between age 60 to 70, any in those 10 years. Okay, again, the best, I mean, the average is usually at 865. These days, it's about 1175 a month. So this again is not a lot. It's like $12,000 a year, right? So 1175. So see, if somebody's getting CPP and old age security together, it's hardly about $1,900 a month.
Right.
Right. That's a maximum amount. If their income has always been over the YMPE, which probably is not going to be the case, most probably people will be getting less than this. But anyways, so this is again also, it is taxed. Okay, you can apply between age 60 65. Here the catch is if you apply early before age 65, your payment is decreased by 0.6% per month. If you apply beyond age 65, monthly payment is increased by 0.7% per month.
Okay.
So this is both. Yeah, that's how it works.
Okay.
So remember, it's a little tricky. Like old age security is increase is how much? Remember here we said increase is 0.6% per month. Here increase is 0.7% and decrease is 0.6%. So keep that. And same thing here, if Alice delayed her CPP payments for 14 months. So now she will get, we have to multiply by 0.7 into 14, we'll get 9.8% extra income, extra payment. So if her CPP was 698, she will now get 766.
Understood. Yeah, understood.
So this is suppose somebody applies at age 60 or 62, and then so they get the CPP and then they go back to work. If they go back to work, then their contributions go to post-retirement benefit. PRB is another, like, what do you call it, plan, like the Canada Pension Plan. And if they are working, they must contribute. If they're between age 60 to 65 and they're getting CPP and they're working, then they have to contribute into the PRB. So this is another like plan from the government.
Additionally, okay.
Mm-hmm. So again, CPP has four things. One, it has pension. Then it has disability element also. So if a person is 30 years old and they're putting money into CPP, of course, from their employer, God forbid they become disabled, they can get disability benefit also. So we'll read more about that in this disability, but that is also something which is included in the CPP. Okay. And then there's survivor pension. If the person dies, the family gets a death benefit of $2,500 maximum from CPP, and then the survivor gets CPP payments. Some of it, about 60-70%. The spouse gets the payments.
Okay.
Okay, so that's also like that is the benefits there.
So Azad, if you're contributing to CPP, employer and employee, four and a half together, 4.5 together, and you do it for a couple of years and you die, can you transfer that to someone, a annuitant, for example? Is that a possibility? Or?
So if the person dies, then that money, then some payment will go to the spouse, to the survivor.
That's the survivor pension you're talking about. Okay.
Yes.
Okay.
That's it. There's no other like it can't be transferred. It's not. So everybody has what is called like a CPP. So if you go on Service Canada website, you can ask for a statement of your CPP. They will send you a statement which shows all of your income, how much you've contributed every year. There is like there could be, depending on income, 30 to 40, $20,000 there. So all of your contributions and your company contributions, they all are recorded in like an account.
Mm-hmm.
Yes, but you can't invest that money. You can't take that money. Only way you can take it is in retirement or one of these reasons.
Okay, I got you.
Okay.
Yep.
So now we come to the third one, which is employer provided pension plan. So company, if you're working with a company, of course, with Sun Life, they will have a pension plan. So every company has a pension plan. Most large companies have a pension plan. Some smaller may not, right? So in there, one is called the defined benefit plan. And that one means that the pension is known. In from the name, you can obviously it means defined benefit. You know the pension from day one. It will say every year you'll get a statement. It will say you're working with the company. If you continue at this salary, then at age 65, this is how much pension you will get. So there's a formula for it. Okay. So the formula may be one of these three. It may be flat benefit, career average, or final average. Okay, so these are the three, four, mainly these are three types of pension plans which are used. Either flat benefit is, of course, you get the same amount regardless of what your income is. So we'll talk about this in the next slides, but there's these three types. They take average of your income, either the whole career or the final average. And then there's another one. This is only for directors, senior people over like $100,000 income. They get IPP, which is also a defined benefit plan, but that's only for, of course, top people, executives.
Okay.
So we'll talk about that next in the more detail in the next slides. Then there's the deferred profit sharing plan. That also we'll talk about it. Basically, whenever the company gets a profit, they put money into the DPSP, and then you can get pension from that also. Okay. And then there's pool registered pension plans. There's group RSPs. There's also defined contribution plans. And the defined contribution plan is the one where benefit is unknown. You don't know how much you will get. You may get more, you may get less than the defined benefit plan. It depends on how investments do. In the defined benefit, in this one, you know how much pension you will get. So it doesn't really matter whether the investments are going up or down. Here, it depends on the investments. If investments are doing good, you get more pension, less, you get less pension. Okay. Yeah, so like we said, it depends on investment growth. So these we will talk about in more detail in the next slides, but this is just a summary to keep in mind for retirement plans with the company. These are the two main ones. Some companies may have this. So the company will have one of these two. They won't have both. They'll have one of these two, and then they may have a DPP. And then the group RSP, usually they do have like, you can put money into RSP plan at work, and then they will also contribute. Usually they will buy you shares of their own company. So if you have a group RSP with Sun Life, they will probably buy shares of Sun Life in it.
Right. Are these plans more company based, or is there, does the employee have the option, or is it just the companies will do it this way, and is that how it is, or? As an employee, do you have an option to pick, or do they just tell you what it is?
They just tell you, like, they will give you that this is like when you're joining, they will tell you this is the type of pension plan we have, and that's it. Then you really don't have an option to choose. It's when you're deciding if you have like 2, 3 offers from companies, then you can see which one has a better pension plan, which one is a better option. So that's but usually like companies, so the companies obviously they do it because they get tax benefits from it, and they want to retain their good people, right? So this is a plus point for companies to retain good talent. So they will provide these pension plans, and it depends on the company. Some companies, smaller ones, they may not have any pension plan at all. You have to buy your own. Then of course people can save their money in their own RSPs. They can have their own pension plans then.
Okay.
Right. So
Understood.
like on your own, they would buy a RSP, and then they would buy an annuity when they retire. With the annuity, they will get a pension just like a pension plan.
Okay. Understood.
So general info on pension plans. So in the pension plan, so they're called registered pension plans because they are registered with the federal government. The government monitors, because there's billions and billions of dollars in the pension plans. Think how many employees there are in like Sun Life and all the banks and all the Sun Life and all the companies, and then how many each of them are contributing, the companies contributing. So it's registered with the federal government. And the plan sponsor is the employer. They are the ones, they will maintain the RPP plan. So that's the plan sponsor. That is the company, the employer, they are called the plan sponsor. They manage the RPP. RPP mean registered pension plan. And it is responsible for enrolling new members, issuing pension statements, keeping a record. So they will usually be doing that. Okay. And
Yep.
then the employees, they're called plan members. So these just words like terminology, maybe when you get a question, that's why I put it in bold. You have to remember this, like plan sponsor is the employer, plan member is the employees.
Okay.
Okay. And so now this here showing you, I'll explain this here. We said that the employee and the employer, they both are contributing into the pension plan, right? And now normally person will retire and they're going to get their pension at age 65 usually, right? In some cases they may take early, but usually it's 65. That's the normal route. That's, but everybody's not going to retire with the same company, right?
Yeah.
If the person leaves the company after 2 years, so there's contributions. The other thing is person, after 2 years, they are going to be, it's called vested portion, vested. Okay, so vested means that they are going to get both the employer and the employee contribution, and they can take that money and they can transfer it to a Lira account. So we'll talk about Lira account in more detail, but Lira account you open up in the bank, or they can open up with you also with financial consultant. You can open up a locked in retirement account. And then from the Lira, they can transfer it to a LIF or one of these other ones. These are in the other provinces, and that is between age 55 to 71. And the purpose of that is that they get a pension, or they can transfer it to annuity. Pension or annuity, both will give them a payment, right?
Right. Okay. Yeah.
So in this way, they don't lose the money. What we're trying to say is that if they leave the company after 2 years, they get the full amount. Okay. If they leave the company before 2 years, they could transfer their own contributions only. They don't get the company contributions.
Oh, okay. Okay. Yeah.
Okay,
Gotcha.
so if they first, let's suppose 1 year they put in $5,000, second year they put in 5,000, and they leave the company, they don't get 20,000. They don't get the company ones. They only get their own 10,000.
Well,
Okay,
okay. Yeah.
this is
Good.
before the 2 years. After 2 years, they will get the full amount, both company and the employer, and their own savings. So they can transfer that money to a LIF account, and then they can get a pension from it.
Understood. Okay. Yep.
Okay, so this is key to remember also. So now we'll talk in more detail about these, like we mentioned here. First one is defined benefit plan, so more detail about that. So with the defined benefit plan, all full-time employees, usually after 2 years, they can join the defined benefit plan. So the part-time also, they can also join usually after 2 years if they meet some criteria, like they should have reached 700 hours or so in the past 2 years.
Okay.
So the contributions are that here we said that employer must contribute. So in all these, usually defined benefit and defined contribution plan, the employer has to contribute. Now, the employee may or may not contribute. If the employee contributes, it's called a contributory plan.
Okay.
If the employee does not contribute, it's called a non-contributory plan.
Mm-hmm.
Okay, it's a little confusing because sometimes this again in the questions they may ask you, it's a contributory or non-contributory. It seems as if non-contributory means that the company doesn't contribute. But in this case, company contributes, but the employee does not contribute.
Okay. So yes, these two terms are based just on the employee.
Yes, right.
Okay.
And so a member makes no investment decisions because it's a defined benefit plan. So we said the pension is based on a formula. It lasts for life. So it usually pays a percentage, usually 60% of the spouse, if the person dies, or commuted value to a beneficiary. Commuted value means same thing, whether it is, if it is vested, if the person has worked with the company more than 2 years, they get both the employer and the employee amount, right? So that is the commuted value.
Okay.
And if they leave before, then they only get their contributions.
So 2 or more years is still for life?
2 or more years, it means that the spouse will get the payment until they die.
Until they die. Okay, gotcha. Okay.
And the payments are indexed to inflation. So the payments will go up if inflation goes up. And yes, pension is a tax. So almost all the pensions are taxed. So keep that in mind also, yes.
Okay.
And so we said the payments from the defined benefit plan can be 3 ways calculated. One is, from the wording is quite obvious, average of career earnings. They will look and see you work with the company 20 years. So it means 20 years, they will take an average of your income, and based on that, they will calculate how much you will get from the defined benefit plan.
Okay.
Or it could be average of the final career. They can say, okay, last 5 years that you worked with the company, we're going to see how much you earned, and based on that, then you will get the payment based on that.
Okay.
And the flat benefit is just based on how many years you work with the company. Doesn't matter what your income was, so they will base it off of that.
Okay.
Okay, so this is
And that is up
defined.
to the employer. I assume, yeah, obviously, right?
Sorry.
It's up to the employer to decide which of the 3, right? Obviously.
Yes. Yeah. The employer decides. Yes.
Okay.
And then the defined contribution plan, that's the other one. This one, from the wording, it means that you both are contributing to the pension plan, the employer and the employee, and the member makes the investment decision. Here, usually they need a financial advisor or they need a financial consultant. If it's a defined contribution plan, the employee has to decide, I want low risk, I want medium risk, I want high risk, I want this investment, I don't want this investment. So they have to make decisions.
Mm-hmm.
So we don't know how much pension they will get. It depends on the investments.
Right.
And then on retirement, the funds are transferred to a lira and then a LIF or annuity. So in this case, they will then transfer to the lira and the LIF just like we saw before.
Right. Okay.
And it pays a percentage, usually 60% of the spouse, same way, or committed value to the beneficiary. And these payments are taxed also.
Okay.
So the other ones we said IPP and PRPP, right? Individual pension plans and pool registered plans. So with the individual pension plans, this is, like we said, this is set up by professionals or for senior executives, usually over age 40, earning more than $100,000. Accrual rate is 2%. So up to 2% of it, they can put into the pension plan. And the advantages are there's higher limits. So this is because there's a limit on how much you can put into the regular defined benefit plan. This is additional. So they will get the defined benefit plan or the defined contribution plus the IPP. So it's an extra like account where they can put money in for pension. And so it's again another like incentive for, senior people to join. And so there's higher contribution limit. They can deposit more if the returns are lower. And so it's a benefit for the company also because they get a tax deduction on it.
So instead of 4.95 with the other plans, this one will be what, up to 10 even, or?
Um, I'm not really sure, but it's more. I'm not sure how much. You don't have to, I think, remember that. But yeah, it's higher contribution limit, probably maybe 6-7%, maybe
Okay.
8%. And so pension is known, pension is safe from creditors. So that's a extra like benefit.
Okay.
And then there's pool registered plan. This is the newest form of the plan. Like a couple years ago, this government started it. And this one is for people who are, it's for administrators offer it to employers and people who are self-employed. If it's a group of like, suppose there's like a brokerage with commission-based employees. So it's similar to defined benefit plan, except employer and employee contributions are not mandatory. You don't have to put money into it. Payroll deductions are made. It's a low cost retirement savings plan for those people who do not have a RPP. And again, here you can put the transfer into it from individual RSP, RIF, or DPSP.
Okay.
So these are, again, another type of plan. Okay.
Yep.
And then deferred profit sharing plan and group RSP. So the deferred profit sharing plan here, employer contributes only when it has a profit. So this, from the wording again, you can remember a little bit. Deferred profit. Deferred means payment later, profit, right? So they will pay you extra money if the company makes a profit. Every year, usually, you know, like the banks and all and the insurance company, they make a profit every year. So whenever they make a profit, they will put money into the DPSP. So this is an extra again. And again, here members decide the investment. This is not a locked in account. So anytime you can take the money out, you will be taxed on it, or you can transfer it to RSP. It's not locked in. So it's flexible money available. And employees do not contribute to it. Only the employer will contribute to the DPSP.
Okay.
And again, investment is tax sheltered until it is withdrawn.
Okay.
Then the group RSP. So this is same as the regular RSP. Only thing is that, so you get we'll talk about this later, home buyer plan. There's a lifelong learning plan. So it's the same as the regular RSP, but it's with the company. The plan again is not locked in, and you can transfer it to the member's own RSP or RIF or annuity, or you can take it out in cash. Right?
Okay. Yep.
Okay. Okay, before we do the RSP math, yes, before we go to RSPs, just to summarize this, you should keep in mind that, you know, we talked about these, right? So we talked about the defined benefit plan and the deferred sharing profit plan, the pool registered plan, group RSP, defined contribution plan. And so are you clear about these?
Yeah, just various different plans that companies can offer, all different scenarios. Yeah, pretty straightforward. Yeah,
Okay, good. All right.
after review, I should be okay with it. Yeah.
Yes, right. So just to go back, also just to remind you, we are going to now talk about RSP now. So these all we talked about, the red ones, the government plans. We talked about the company pension plans, the green ones, right? Now we're going to talk about personal saving, your own saving you can put into RSP and tax-free savings account. And keep in mind, RSP will go to a RIF account, right? So those are like, they go to RIF account in retirement. The company, yeah, the company pension, I should add here also, there's also group RSPs, but, and other ones also. There's not just these three, there are others also, the ones on the next slide. But anyways, there's a group RSP, which could be with the company, and then there's an individual RSP also.
Okay, yeah, gotcha.
Okay, so we'll talk about those next. So for those ones, right, okay, so RSP, there's a limit. So the RSP, there's a benefit for putting money into RSP, right? Because the person can reduce their taxable income, right? Now we have to first see what is the earned income for the person. Salary, whatever person's salary is, that counts as earned income. Obviously the person is working, they're earning this money, right?
Yeah.
The bonus, person gets a bonus, that also is considered as earned income because they're going to get that money in their account, right? Rental property, they have a rental property, rental income, I should say, rental income, like from the rental, $16,000. Now, they have an expense on the rental property also. Suppose 8,000, they're paying the interest, they're paying other stuff, right? So they're getting dividend income also, suppose. So they have stocks also, they're getting $3,000 dividends. Then they're paying their spousal support $12,000 a year. Suppose they broke up, here 50% marriages don't go through, right? So here, suppose they're paying spousal support $12,000 a month to their spouse. And then they have a pension adjustment of $10,400. Okay, so now the question here could be that, okay, how much can they put into their RSP? So this is like a question that will come up. Have you seen these type of questions?
Yeah. Briefly, yes.
Okay, so how to do it is you have to keep in mind that we're gonna, in order to calculate the RSP contribution limit, we have to only take those income which are earned income. Okay, salary is earned income because you obviously are working and getting the money. Bonus is earned income also. Okay, the rental income, we have to take net income. We have to take 16,000 minus 8,000, $8,000 we have to take as the earned income. Okay, the net amount, not the total amount. Dividend income, we don't take any dividend. If you have stocks and if you're getting dividend income, you're not working for it. There's no effort involved in it, right?
Right.
So investment income is not included in earned income.
Is not, okay.
No, that's why it's X, it's not included.
Okay.
The spousal support, this we're actually going to minus because they're paying it from their pocket, right? If they're paying it, we'll minus that money. And so this is how we do it. So we take the 80,000 plus the 14,000 plus so 16,000 minus the 8,000. Clear so far?
Yep.
We don't take the 3,000. We take, and then we minus the 12,000 also.
Right.
Okay, so if you do that math, you'll come out with $90,000.
Okay.
So this is first thing to keep in mind. Okay, then we have to multiply it by 18%. So the earned income is multiplied by 18%.
Okay.
And when we do that, it'll come out to be 16,200.
Okay.
And then we minus the pension adjustment. This here, pension adjustment is an amount which is calculated by the company based on their contribution, your contribution into the pension plan. This will decrease the amount of money they can put into RSP for that year. So we have to minus this from, after you do the 18%, calculate the earned income, take 18%, then you minus the PA from it.
Okay, at the end.
At the end, yes, not before.
Okay.
So now this means that so what is this 10,400? This is meaning that it represents the value of pension benefits accrued in that year. That is their benefit that they're getting from the company because the company has contributed to the pension plan. So now we're left with $5,800. And that is what he can put. This is the money that they are allowed to put into RSP in that year based on this formula. So the formula is add up all the earned income, don't take the dividend. And if they pay spousal support, you're minusing it. If they're receiving spousal support, you need to add the spousal support. So the spouse who's getting the money, if she had the same thing, she would add the 12,000.
Right. Okay.
Okay, so 9, and then you take 18% of it, and then you minus the PA. So this is the unused RSP room. And if they don't use this year, it is carried forward. If you don't put in the money this year, then they can carry forward to the next year.
Okay, cool.
So now they can do one of two things: either put it into their own account, own RSP, or they can do what is called spousal RSP contribution. So if they put it into the spousal RSP, so let's suppose so there's Adam and there's Mary. They both are going to be spouses. So if Adam has 5,800 contribution room, he can contribute to his spouse's RSP, Mary's spousal RSP, and Adam will get the deduction. By deduction, we mean that will reduce his taxable income.
Okay.
Okay, so that's one option. Other option is he could put into his own RSP, and then still he will get the deduction for his own self. So it doesn't matter either way, he will get the deduction. and he can put it either in his own RSP or his spouse's RSP.
Okay.
So like we said, if he has a spouse, if the spouse earns less money, let's suppose the spouse is only getting $8,000 a year. She's staying at home and just doing a little bit extra work. So 18% of that is 1440. Now this is her RSP deduction limit, right?
Mm-hmm.
So it's beneficial to put into spousal RSP if they're getting a lower income. Then it means they will get more tax benefits in retirement.
Right. Okay.
So
yeah, I see why a lot of people do that now. Yeah.
yes, that's right. Yeah, the lower spouse, they will be getting a benefit by when they retire, then they don't have to pay that much taxes on the pension income.
Okay.
So this 5,800 we took, but you can also add $2,000 is a lifetime over contribution. The government allows you to go over 2,000. It's not annual, it's one time. There's no penalty for it. There's no deduction. It's just to keep a buffer. Some people, they may not calculate properly or whatever. So this is just an extra buffer they're allowed to put in 2,000 over the limit.
Just one time, you said, right?
Yeah, one time in the lifetime.
Okay.
So that means 7,800 is how much the contribution limit. If they go over the limit, now there's a 1% penalty per month. That's a 12% penalty if you put in extra money there, because that is beneficial for the client if they do that, because they will save on the taxable income, right? So there's a limit, there's a penalty for going over the limit.
Right. Okay. Gotcha.
So is that clear? All this, the math is clear?
Yeah, it's pretty straightforward. Yeah.
Yes, good.
Much better than the textbook explained it.
Yeah, I know. Yeah, so you need to do some calculations, like make up some numbers or do some questions in you probably have that online, do some questions there, but this will give you a guideline how to do it, right?
Okay, and just one question, just for my own knowledge. So I see right at the bottom where the pension adjustment is there anything else, any other thing that could deduct it further other than that? Like in another, just for my own knowledge. I mean, is that the only increase?
Yeah, no, just the pension adjustment is the only thing. There are others also. Actually, there are some other. I don't think they mentioned in your book. There's PSPA, past service pension adjustment. There's some other also adjustments, but the main one is just the pension adjustment, which everybody will have if they have a pension plan. They will have a pension adjustment. Other ones are sometimes if somebody, suppose, leaves a company and then they rejoin the company again, then there's a special adjustment for that. Okay, but that's very rare, right?
For the exam, I just need no pension adjustment, I guess.
Yeah,
right?
It's just PA unit. Okay, so the RSP, we said the benefit of RSPs is when you put money into RSP, you get a tax deduction. So it means it reduces your taxable income, right? So it means whatever your earned income is that we calculated, you take 18% of it and then you minus the PA, you're going to get the RSP deduction limit. And in 2018, there's a limit on that also. The maximum in 2018 was 26,230. Okay, so it depends, it changes every year. But so if somebody's income was, let's suppose somebody's income is $100,000, right? So that's 18% of that is going to be $18,000.
Right.
So that'll be lower than the limit. But if somebody's income is $200,000, right? So then it's going to be $36,000, which is not right. Then the maximum they can put in will be 26,230.
Okay.
Okay.
That's the absolute max. Okay.
Yes, that's right. So you must know the 18%. You have to remember that. That's a very key, important point, right? Okay. So in the RSP, it's your own money. You put it in. You can take it out anytime, but yes, you are going to be taxed on it. So if you put in money in the RSP 1 year, your income is low, and the next year income is higher, and you take it out, you're going to be taxed higher amount. So it's not, the purpose is put in the money when you're earning high income and take it out when your income is low in retirement. Then you have a benefit, right?
Right. Okay. Yeah.
So anytime you take out the money, there is what is called withholding tax advance. That is an advance payment. If you take out money from RSP, the bank has to withhold some money and prepay that to the government. So that is like a requirement from the bank. So what is the rate? This is in all of Canada except Quebec. I think you have to remember this. Don't worry about the Quebec one. if they take out 10%, sorry, if they take out $0 to $5,000, it's 10% of the withdrawal.
Okay.
So if they take out $4,000, it'll be $400, right?
10%. Yeah.
10%. If they take out 5,000 to 15,000, then it's 20% of the withdrawal. If it's more than $15,000, 30% of it will be paid to the government. And then when you do your taxes next year, then you may need to pay more, or you'll get some refund. Depends.
Oh, you pay tax twice.
No, not twice. This is advance. You're paying it in advance. So see, anytime you take money out from RSP, you are going to be taxed on it because you never pay taxes on it.
Right.
If this is the deduction is meaning that suppose somebody's income is $60,000, they put 10,000 in RSP. So now their taxable income is going to be 50,000.
Right.
Right? Now that 10,000, it's in the RSP and you don't pay any taxes on it. You get profit on it, you get income on it. And then whenever they take it out, there will be withholding taxes. They have to pay taxes on it. So this is advance payment. And then when they are going to do their taxes, then they will be taxed on it accordingly.
Okay, gotcha. So it's
not double taxed.
It's a one payment. Yeah. Okay.
Yes.
Okay.
So that's one thing to remember from RSP. Other things is home buyer's plan, life learning plan. So these we'll talk about in the next slides more detail. But the main purpose is they can save money for down payment for a house. And then there's lifelong learning plan. They can take out money from the RSP for tuition. So the benefit of this is that there's no taxes. You don't pay any taxes on the money when the money is taken out. So this is a good idea to do that if a person wants to do it for study or for home buying. So in the RSP, so RSP we said is the account, right? This is like a shopping cart. In the RSP, you're allowed, you can put the money in there and you can invest it in stocks and bonds and mutual funds and segregated funds, or you can just leave it in a bank account. You can put GICs in it. You can buy derivatives. So there's all these investment options are allowed. So those are the they're called eligible. They're eligible for the RSPs. There's some exceptions. You cannot put real estate like property. You can't buy a property and put that money, put that into like an RSP, or art. Like for example, people buy a painting or something. You can't do options. You might have heard about options. These are like some different types of investments. So there's exceptions to it, right?
I just have a quick question. Forex, would that would probably be an exception as well?
I'm not sure about Forex. I don't know. I'm not sure. You have to check and see each company. They have their own rules if you can put Forex money into RSP or not. It depends on like the account. If you just like you can, so I know you can put like, you can buy penny stocks and all in RSP, but I don't know if you can do Forex. I'm not sure about it. You have to ask the company.
Okay. Oh yeah, I'll check that out. That's fine.
So the investment choice is the same thing with RIF, LIF, LIRA, all those ones we talked about before. We'll talk about RESP also, RDSP, TFSA, same thing. Those are accounts and you can put the money in those accounts and then invest them as you like into any of those investment options. So the purpose of RSP, so one benefit, number one, is you get a tax deduction. That is, it reduces your taxable income for the year you put it in. So right away, you put the money in. Next year, when you do your taxes, you will probably get some tax refund, right? Mm-hmm. That's an immediate benefit. Number two benefit is every year. So somebody is 30 and they contribute and they're going to retire at age 65. So for 45 years, they've been paying, for 35 years, they've been paying into the RSP. They get tax-free growth. This growth, there's no taxes for all those years on the growth. So every year, they don't need to pay any taxes on it. So that's a second benefit, right? Third benefit is the home buyer plan. Then there's also lifelong learning plan. So all these are benefits of RSP. Then when the mature RSP means no later than December 31st of age 71. This means that the person has to do something with their RSP before then. Usually people do it at age 65, right? That's normal. But if somebody doesn't want to, or they don't care or whatever, they must do it by age 71. They have to do one of these things. Either they take the money out in cash in lump sum. Of course, it's not recommended. If you have 200, 300, $500,000 in RSP, you don't want to take it all at once. You'll be taxed on it 100%. So it's a good idea to put into RIF account. Most people decide to put in RIF. In the RIF, it continues to be invested. If it's a stock, you can continue with the stock in the RIF. There is a minimum withdrawal you have to take out every year, a certain percentage. And the withdrawals are taxable, but there's no maximum withdrawal. You can take out as much as you want to from the RIF.
Okay.
So that's a benefit of, so then from the RSP, it'll go to RIF account. Or the other option is to go to annuity. And annuity, remember we talked about annuities in chapter 3, right? Yep. So annuities will be you put your money in. So this is like that person who says, I don't want to worry about investments. If I put it into my stocks, bonds, they're going up, they're going down. I have a GIC certain interest rate. I'm going to check what the interest rates are. They're down. They don't want to care about these things. They just want a payment. So then they will put into annuity. It's a guaranteed income, no more investment income, no more investment. It's just a fixed income. And you don't worry about the investment. The company, the insurance company does the investment. And again, the income is going to be fully taxable. Remember, we talked about annuity. That is the annuity from the registered plan. Remember, there's two types of annuity, from non-registered funds and registered funds.
Yeah.
Right? So the non-registered annuity can be prescribed or accrual, right? And this is the registered one. The registered annuity is coming from, so where's the money coming from? It's coming from a RSP, and this is coming from your own contribution, from the person's own money that they never pay taxes on, right? So that money now, when you take it out, it's going to be taxed, right?
Okay. Yeah.
So in the RSP, you can split it up also. If they have, suppose $30,000 there, they can put 10,000 here, 10,000, then take out 10,000, put annuity. You can split it up, but you have to do one of these three things, and then you're going to get some payments from here. You're going to get some payments from here, and this you'll be taxed on it, but you can take that out also.
Okay, understood.
Okay, clear?
Yep.
All right, next we're going to talk about income splitting. With no income splitting, so this is allowed for RSP. For all the pension plans, you are allowed to split the income with the spouse. So let's take an example. Your spouse A is earning $100,000 in retirement. They're super rich. They got, rental properties. They got a consultancy. They got other business. They're working also, or whatever. They're doing some business, maybe consultancy. So they got a good income. The spouse is only getting like $20,000 in retirement. So now if this person is at a very high tax bracket, so as you know, there will be old age clawback, also OAS. They're not going to get the OAS. Remember, the OAS limit is like 60,000, 70,000.
Yeah.
Right. So they're not going to get that. She's at a very low tax bracket. So the government says they're better off. You can add them two up, 120, and divide it by two, $60,000. So you can do that. You're allowed to do that with the pension income.
Okay, gotcha.
So that is a big benefit. Now, this person is going to be at a lower tax bracket. There's no old age security clawback, so you're going to get the $7,000 from the old age security also, right?
Yep.
And she's going to be at a higher tax bracket, but still, it's allowed to do that. Overall, if you calculate, he's going to pay high tax here, and there they end up paying less taxes. So you can't just, if he gives the money to her, there's an attribution rule. Attribution rule means that the person who contributes money to the others, there is going to be attribution. The tax consequences flow back to the original spouse. So it's better this way. When you do the taxes, you can split the income this way.
Okay, excellent.
So there's several ways you can do that. Number one is so this is before retirement. They can, spousal RSP contribution is one way that this has happened because this person did not put into spousal RSP before when they were, working, right? So if they did that before, they wouldn't have this problem. They would have ended up like this. But even if they are ending up like this, then they can still do CPP pension splitting. So one spouse over age 65 can transfer pension income to the other up to 50% in the tax return. So it's when they're doing the taxes, they just mention there, oh, I'm transferring so much money to my spouse, she's going to pay taxes on it.
Right.
So all these can be split: lifetime annuity, RSP income, RSP annuity, RIF income, DPSP income. Remember, this is from the pension plan. Um, these all can be split. Key thing to remember here, very important, sometimes you'll see in the questions, old age security cannot be split.
Oh, yes. Okay.
Okay, OAS is not here. CPP is allowed, right? RSP is allowed, RIF is allowed, DPSP is allowed, but old age security is not allowed. Sometimes they'll give you a list of pensions and ask you which one can be split, which one cannot.
Okay. Good to know.
Okay. Example, let's take a look at the Donald's getting 24,300 as pension. His tax rate is 37%. Betty has a tax rate of 22%. So if you calculate 24,000 into 37%, Donald is paying 8,991 as tax.
Right.
Right? He can split half of it. Half of this is 12,150.
Mm-hmm.
So now 12,150 into 37, he pays 4,495, and Betty is going to be paying 22% on that one, which he split with Petty. So she's going to pay 2,673. So now if you add these two up, this works out to be 7,168. So the saving is between these two, the difference, they're saving 1,822. Just on the tax return, by doing that properly, they can save that much money. They could take a vacation or something, right?
Yeah, smart way to do it. Of course. Yeah.
Yes.
Okay.
So this is income splitting is allowed, yes.
Okay, perfect.
So now we talk about spousal RSPs. So spousal RSP, we said contribution must remain in the plan for 2 years, for a year of deposit plus 2 years for the withdrawal to be taxed in the lower marginal tax rate spouse. So here we said, let's take a look at this example. Victoria is earning $120,000. David is a stay-at-home husband. He's got zero income. Now, Victoria contributes $5,000 to David's RSP in 2011. She puts it into spousal RSP because that's beneficial for them in retirement, right? So 2012, she puts another 5,000 into his RSP. Or she stops. So now in 2013, they withdraw $12,000 from the RSP. So she has here $5,000 here, right? Now Victoria's spousal contribution for the past 2 years are undone. So 10,000 is going to be taxed to Victoria. Now this $5,000, it has not been in for the year of deposit in 2 years. It has not been in for that long, right? So even though she contributed to David's RSP, Victoria has to pay taxes on this. Same thing for this one also. So $10,000 she has to pay taxes on that, and $2,000 will be David's. David will pay taxes on it because the 2,000 has been in for longer. We're assuming they had put in money before also.
So this, I was reading this before. This is one concept. I wanted to.
Yes.
Okay, that's good. Well, we have it recorded, so I could go back. That's fine. Okay.
Yeah, the main purpose to remember is that any money you put in, it has to be in for. Think of it, if you put it in January of this year, so it's January plus 2 years, so it's almost 3 years. Right? If you put it in December, it's just like 1 month. Right? If you put it on December 25th or 26th, suppose the bank is open, you deposit, it's just there for 3-4 days, and then 2 more years. So that's like, so it depends on when you put it in. And so, but the money, if you take it out, they're going to see what you put in for the last 2 years. That is going to be taxed in the contributor's hand, and the rest will be then taxed in the other person's name.
The other person, the rest of the other. Okay, gotcha.
Okay, all right. So RSP withdrawals that can be made with no tax. So this is the benefit of home buyers plan. $25,000 per spouse they can take out to buy a home out of RSP, right?
Yep.
And this is for couples purchasing a qualifying home, right? And they cannot have owned a home in Canada for the past 4 years, right? And the money has to be in the RSP for 3 months at least. Then
3 months.
it can, yeah, 3 months it should have been. They can't just put it in and take it out right away, right? So they can do that also. Okay. Then the okay, and then you must repay the loan. It is a loan from your own self, right? So in the year that you buy the house, you don't have to pay anything back to the so they don't have to pay that back to the RSP in the year they take it out, okay, or the first full year after. Okay, so that's, they don't have to do that. But they must repay the loan or face tax consequences. Okay, so actually last year they increased this also to 35,000. I don't know how much is it in your book. Do you have it?
25,000. Yeah.
It is 25. Okay, but yeah, last year they changed it, so they haven't updated. So just remember 25. So they must repay the loan or pay the tax consequences. If you don't pay, failure to make payments result in tax payable on that amount for that year. So, for example, 2013 he withdraws from home buyer plan. So 2014 he buys the home. They have to buy the home before October 1st of the next year. Okay. So that is the requirement, that they must have bought the home before October 1st the next year. And then it's 15 years. You have to pay back the money in 15 years, 1 out of 15 per year for the next 15 years. So if it's 25,000 divided by 15, so that's like 1,666 they have to pay back every year to their own RSP.
Without getting consequences.
Yes.
Okay.
So the lifelong learning plan also works similarly. They can take out $20,000 per spouse. This also is for study, for tuition. It's $10,000 per year per spouse, up to $20,000. Okay, so repayment starts either first year not in school or fifth year after withdrawal. So if they stop going to school, then they have to start repayment, or fifth year after withdrawal.
Okay.
And so it has to be a qualifying education program, and there's a 10-year repayment for this. For the home buyer, it was 15 years repayment. Here it's a 10-year repayment. Funds have to be in RSP again for 90 days to be able to take out for lifelong learning plan, right? Mm-hmm. So clear about those two. Like these are extra benefits because this is your money before taxes, so it's easier to save in there for this.
Yeah, very, very clear. Yeah, your explanation makes it so perfect.
Good, good. Okay, on death, what happens? So if somebody has a lot of money in their RSP and the person unfortunately dies, suppose the person's 50 years old and they have 200,000 in their RSP, that money they never pay taxes on, and they have not reached retirement. They have not taken the money out. That money will be 100% taxed on the death. On the next year, the family is going to file the taxes, and then the government is going to say, okay, you'll have to pay taxes on it. So this is another reason to buy life insurance also, right?
Okay, yeah, okay.
So that is, and so the RSP money goes to any beneficiary who, if it's spouse, it goes tax-free, but if it goes to children or anyone else, it is going to be taxed. So we said tax-free is allowed to certain beneficiary. It can go to spouse, common law partner. It's called rollover, tax-free rollover. It can go to the spouse's RSP. It can go to a minor child. It can go to, but it must be annuitized. It must be converted to annuity by age 19 of the child. It can be transferred to a disabled child at any age. And here there's no annuitization. You don't have to put it into annuity. It can go into the whole amount can go to the child. And receivers, it has a rollover into RSP.
Okay.
Or they can put maximum 200,000 to the RDSP. So do you know about the RDSP, Registered Disability Savings Plan?
Very vaguely, yeah.
Yeah, that is for like disabled people. Their parents can put money into it for their children. And this here also is So that is another benefit, okay?
Okay.
So for the RIF account, this RIF account is, remember, it's coming from RSP, okay? So Steve puts $190,000 in RSP, save that money up. Now, December 13, 2014, October 22nd, let's suppose in 2014, he is going to be age 71, right? So December 31st, 2014, he must mature his RSP, okay?
Okay.
So that is like a requirement. So January 1st, 2015, if he has 190,000 in RIF account, he must transfer it to the RIF account. If he does that, there's a minimum withdrawal. There's a table. So again, there's like, that's why I said you need to remember like where the, if they ask you how much it is, you should know it, or either they give it to you or you have to look in the table 4.2 and see what is the minimum withdrawal based on his age. If you look in that table, it will show that it's 5.28% is for his age, his based on his age 71.
Okay.
So 190,000 times 5.28% means he has to take out $10,032 this year is the minimum withdrawal for his RIF.
Okay.
So that's the minimum withdrawal. There's no withholding taxes on it. So the key thing to remember also is, remember in the RSP we said if they take out money, there is a withholding tax. Here
Yes.
there's no withholding tax for the RIF minimum amount.
But there is, okay, so they force you to take some out, but you don't have to pay tax on that, the amount you take out.
You will pay taxes on it when you file your taxes, but not right away. If
Not
you
right
take
away.
out in January, February, March, you don't file taxes till the next year, right? So it's basically there. You do have to file taxes on it. It's not that it's tax free. It's just you don't have to pay taxes when you take it out.
Okay. Gotcha.
So that was December 31st. Yeah. So December 31st, 2015, he's taken out 10,032. Now he has 189 left. And then next year again, so now his age is going to be more. His age is going to be now 72. If you look in the table, 72 is 5.4%. So then he has to take out 10,258 from it, right?
Okay.
And
Yep.
continue so on. So this is how it works with the RIF account, right? If his wife is younger, he can base it off the minimum withdrawal based on the wife. If you base it off of that, the formula is RIF amount divided by 90 minus age. So let's suppose he has $190,000 in the RIF account. You divide it by 90 minus 66 is the age. So now if you calculate that, this works out to be 7,916. So, I mean, it depends if they need the money, if they have to depend on it, it's not useful for them. They might as well take out the 10,000. But if they have a lot of other money and they don't want to have to pay taxes on it, because they have to pay taxes on the RIF account amount, then they may they may want to take out less. And the only way to do that is to base the withdrawal on the younger spouse. So of the two, the younger spouse can be the one based on which you calculate the withdrawal.
Okay. I just have a quick, sorry to interrupt.
Yeah.
I think I have until 6:30. I just have to pick up my daughter. I just gotta,
Okay, you have to go at 6:30. Okay. So what
yeah.
we'll do is we'll stop at 6:30 and then I can give you back 10 minutes again next time when you have time. So
Okay.
it's okay. We have 7 more minutes, right? We can finish 6:30, or you
Yeah.
want to stop now?
No, 6:30 is fine. Yeah. 6:30 is
Okay.
fine.
All right, we'll go till 7 more minutes. Okay. So this is the concept for that. Okay, next is TFSA, tax-free savings account. So this is again minimum age 18, have to be a Canadian resident. This was introduced in 2009. There's been different amounts you can put in every year, but the basic thing to remember is that whatever the amount is for the year, you can also add unused room from previous years, and you have to add previous year's withdrawal. If you take out money one year, you cannot put the money back in the same year. You have to wait till the next year. So,
Okay.
so that's like there. In January 2009, a taxpayer who invested 5,000 stock in his RSP, or sorry, in TFSA, it grew to $8,000. Suppose it went up. He took out the money in 2009. Now in 2010, how much can he put in? let's suppose it's again 5,000 you can put in plus 0. He doesn't have any unused room, but he can put in the 8,000 that he took out last year.
Oh, okay. You can put it back too. Okay.
Yeah, he can't, if he took this out in, suppose in January, he put it in February, it went up, he took out 8,000, he cannot put that money back in till the next year.
Right. Okay.
Okay. Then he can put in, so he can put in 13,000 next year.
Okay.
In March 2009, his neighbor does the same. If the stock went down 2,000, he withdraws and spends it. Said, forget it, I lost 8,000, $3,000. He takes out the money and spends it. Next year, 5,000 plus nothing, plus the 2,000, he can put that back in now, the one he took out. So whether it went up or whether it went down, that money you can redeposit the next year, not the same year.
Okay.
All right, so RESP. So here anybody can put money into RESP up to $50,000 per child. So the plan can be a family or a non-family. In the family plan, all the beneficiaries are grouped together. In the non-family plan, only one beneficiary. It's one person each, they get their own plan. So like, kids might fight. It's better to keep like separate plans for each of them separate. And then the group plan is a series of non-family plans. So it's similar to RSP. You put the money into it, and there's tax deferred growth, meaning that the growth is you don't pay any taxes on it until you take it out. The money you can get from it is the government gives you a grant on it, right? So it depends on the person's income. If the income is less than $85,000, you get 20% on 2,500. So if you calculate what is 20% of 2,500, it's $500. 500 is what you can get extra. So if you put in 2,500, you get 500 from the government. So that means that you will get 3,000 in your account.
Right. Okay.
So 42,500 to 85,000, if you put in that range, then you get 30% on the first 500, you get 150, and then 20% on the next 2,000. So it means you get $50 more basically. That's all the benefit is there. Instead of 500, you get 550 from the government.
Okay.
And if the income is lower than 42,000, then it's 40% on the first 500, which is 200, then 20% on the next, which means you can get $600 maximum from the government. So it varies, depending, 500 to $600 extra you can get from the government, depending on the income.
Right. Okay.
And then there's the Canada Learning Bond. This is a one-time $500. You can get that from the government. Plus, there's $100 per year for the next 15 years. So that could be a potential extra $2,000 if they're at low income. So this money is invested similar to RSP, we said. So what happens to the money? If the child does not go to college up to age 35, even you can keep it open. The parents take back the contribution. There's no taxes on your own money that you put in.
Oh, great.
Yes, but because the money you put in is after taxes. So the government's going to take back their grant. So if it's up to $7,000 that you could have got grant from the government. So the government will take back their money, and growth is taxable to the parents. So growth is going to be taxable. So the parents have to pay taxes on the growth. So there's three things in the RESP. One is the money from the parents, one is money from the government, and then you invested the money, and there's growth, right? So the growth will be taxed, right? Let's suppose they put in 20,000 plus 7,000 is from the government, so 27,000, and there's 3,000 profit. So the 3,000 will be taxed.
Right.
And that's going to be taxed at the marginal tax rate plus 20% extra, because you basically got growth on the government money also, right?
Wow. Yeah.
Or you can transfer it to their own RSP or to the spousal RSP, and they must have room there also.
Okay.
Okay. And if the child goes to school, child is taxed on any previously untaxed amount. So the contributions are never taxed. The contributions are tax-free, but the growth and the government money, that will be taxed by the child, to the child, in the child's hand.
Gotcha. Okay.
So RDSP also, let's There's 1 more minute left. Yeah, sorry, I was thinking we have 10 more minutes, but you need to go, right?
Yeah, sorry, Azad. It was a kind of a little emergency. He's
Yeah,
yeah,
I was,
I have
yeah,
to
I know
pick.
we just have about, okay, so what we'll do is we have to finish this up, but it's just basically, you might have seen just 10 more slides, right? So next time you can read through those and then I'll finish those up in 10, 15 minutes next time. And then we will continue with our regular like 1.5 hour for the next. So you wanted to do live, I think, on Monday, right?
Yeah, so I'm scheduled for Monday. Azad, if it's easier for you, we could add the or if you have time permitting, you could add the 15 to the Monday or Wednesday session if that's easier instead of doing a separate one.
Yeah, we'll add it to that. Yeah, let me stop
Yeah.
recording. Okay, I'm gonna stop.